866-653-7526 to take advantage of our March Madness offer. And we're trying to make sense of what has been some market madness, and there is no question that the longer that this volatility continues, which is now going on about 14 months, right? The market high was January of 2022, and we've had lots of episodes to kind of talk through the whys, all of the things that are happening in the economy, but it wears on investors. You know, I was thinking just this week, we had a multitude of reviews with some of our clients, and we're starting now to have annual reviews where it's the second time around where the stock market has been rocky. And, of course, we have clients with diversified portfolios, and some of those investments have done better than others. But as a general rule, the stock portion has really been on a rough ride now for 2 consecutive annual reviews, and it can affect your mindset.
Yeah.
Well, and Scott, I think the key for investors is to understand what you can control and what you can't control, and worry about the things that you can control and don't worry about the things that you can't control. And that really does set us up for the misconceptions that we're going to talk about as far as the market is concerned. But I think that is a very legitimate frame of mind to take on this, a very legitimate approach, because Teresa, as we all know, worrying about things we can't control is just futile.
Yes, and I think that there's strategies that you can put in place, like you talked about before, for some of those things, certainly, that you can control. But there are a lot of pieces that no matter how good your advisor is, it's not going to be a perfect ride. It's, you know, just like the S&P, when we look at charts, it's never just straight up. We've got to be prepared for the ups and downs, but we all know your goal. Your goal is financial independence. So when you're focused on financial independence, that keeps you from getting tunnel vision on one little area.
Right.
And that's what we're really trying to do.
Yeah, and I think that one little area tends to be my account value, right? I mean, that is where the shift away from what we should be focused on occurs. It is hard to see that the overall account value go down and stay there for a significant amount of time. But the reality is it still doesn't offer. If you're thinking like that, if you're thinking, man, my portfolio's taking a beating, I'm not going to be able to afford to retire just because the value of my portfolio is less than it was 14 months ago. That's not really the way you should think about it. It is all about your income, and if your assets are put into a strategy that we expect it to occasionally go up and down. As Teresa mentioned, it's not a straight line to the top. It's not linear. Then that should be part of your plan, to expect that volatility. But to John's point, as we dive in today on the misconceptions, let's talk about what we can control and what we can't control. We've got a chart for our video viewers on the retirement equation, and it's got basically retirement in the middle of the graphic. Here you see it. And then everything around it, the satellite circles, are put into categories of what we can have total control of, what we can have some control of, and what is completely out of our control.
And by the way, this graphic can be seen in the comments in our show notes on YouTube and on Facebook Live.
I think that's a great place to start. When you look at what we can control, it's our saving versus our spending, right?
Yep,
we can
100%.
That is the easiest thing to do. And when I remember doing an interview for a Little Rock television station a few months ago, and one of the questions that the reporter asked me was, what can someone do to prepare for a recession? And one of the things that came to mind to tell her, first of all, is the time to prepare for a recession is not right before it happens. It's months and years in advance, and that is what I was talking about here, saving versus spending. If you're going to be prepared for inflation to run at 6% and the cost of your goods to be more, you have to have that margin, right, between your income and your expenses and what you are saving. That all has to get in alignment first, and that is completely in your control.
John F. Kennedy, the president, said the time to fix the roof is when the sun's shining.
Yeah.
Not when it's raining.
Right.
Yes.
That's
and I think
point.
you have the emotional bandwidth to make those decisions when you're not in panic mode. So that's why it's so important to prioritize that earlier and not wait for the storm to hit.
The other thing that's in our total control is asset allocation and location. So when you think about that, we just mentioned that our clients are coming in for reviews. They have diversified portfolios. Spreading your portfolio over multiple asset classes, and there really haven't been too many places to hide in the short term if you look over the last 14 months because fixed income has performed as negatively as as stocks for the most part in 2022, but that outlook is now more favorable for fixed income. You have things like real estate as an asset class that has performed better than the market. We don't know, and that kind of leads me into the next thing, what asset class or what particular area of the stock market is going to perform better on any given 6 to 8 month window, 12 to 18 month window. We can look at the economic data. We can look at the technical side of this. But guys, when you think about what's out of your control, and that number one thing is market returns on that chart, that is something that I think people struggle with, is the idea that no matter how intelligent you are about the economy or the market market is completely out of your control.
Well, and I think that what is, I would add to this circle that we're talking about on this chart, Scott, that strategy is totally in your control. What strategy do you employ to actually reach the outcome that you're looking for? Because I think at the end of the day, if you're trying to plan for retirement, you should look at what is the outcome. What is it that I'm wanting to get from this? And it shouldn't be, oh, I want to get a great rate of return.
Right.
The objective in retirement, Teresa, is income.
Yes, and I think because we cannot control market return, there are strategies that we use here at GenWealth to protect our clients' income for retirement. But even if you're far out from retirement, say you're in my boat where you're in your 40s and you're trying to figure out how to handle market return issues, right? This last year, even for me, it's been struggle to control my mindset while the market has been volatile. I had a conversation with a client several years back, and then we did a review recently, and he reminded me of it. I'd forgotten. But he said when we met originally, the market was being volatile, and he was all worked up about his account. And I asked him, has anybody stolen any shares out of your account? Are your share counts down? And he went, well, of course not. I said, well, then you're okay. Nobody stole your money. It's not like it's disappeared. You have shares in there. Those values will fluctuate, but your shares, the accumulation of those shares is really your priority when you're further out. So don't focus purely in on the market return because we can't control that.
We can add in there what we can control, especially in retirement, is when we sell something, because that's your point, right? If you haven't sold anything, then it's just a number on a page. It is an unrealized loss at this point. Just to finish up the graphic, because we need to get into the misconceptions, the other thing that is out of your control is policy about taxes, savings, the rules about retirement, always changing. They've changed more in the last 3 years than they probably had changed in the decade prior to that.
Interest rates.
Yes, interest rates.
Inflation.
Those are things completely out of your control. That is the economy, right? Not your economy.
That's right.
And then some things you have some control over. Longevity, obviously your health, you can take some control over, but you really don't know the date that you're going to die. And employment earnings and duration, I think that's a great point to bring up too, because we talk about that when people feel like they're too pinched, that their income and their expenses and the gap between their income and expenses is too tight and they can't find a way to save. That is something you have some control over, is upward mobility in your career. Look for more education, look for opportunities to be promoted. So this whole idea of what we can control and what we can't control leads us into misconception number one, and that is me or my advisor are in control of market returns. And we've already alluded to that. We showed it on the graphic there. Market returns completely out of your control. But I do think that whether that is you as an individual investor, if you tend to be a do-it-yourselfer, you do kind of have a feeling that you can outsmart the market sometime, right? If I pay enough attention to it, if I read all of those newsletters that those gurus are sending me, which, by the way, you pay a subscription for, and that's kind of how they get wealthy,
right?
Then you're going to be able to make the right picks, get the better rate of return, and maybe you're even into, in this time in the market cycle, I'm going to get out of the market while things are choppy, right? And sit on the sidelines. And then maybe you even think that that's what your advisor's role is, right? That we're going to be able to have some secret investment back here behind us that nobody knows about, that we're going to be able to make you money in a down market. Now, certainly, I think there is value, going back to that diversification line of thinking, that we can look at different things that should hold up or could hold up better than just being in the market. But the reality is, there is no way you can control market returns.
And the fear I have in people thinking this is that those who see themselves as failures. I've had a ton of people come in, and when they sit down with me, they're like, listen, I've made all these mistakes. I can't ever really match the market. And I have to tell them, nobody really can. So I feel like it sets people up to think they're bad with money if that's their expectation.
Well, and that leads us to our next chart that I think is really interesting. And if you're a regular listener of the Get Ready for the Future show, you're going to go, well, you've already told me this, but we're going to keep telling you till you get it and actually respond to it. But if you take a look at this chart from Dalbar, this is the annual study that they do about investor performance versus the market. And if you take a look at this chart, I would direct you to the first column, the average equity return for an investor. And let's take it over the last 10 years. The last 10 years, and this is as of December 31, 2021, over that last 10-year period of time from that backwards 10 years, the average investor earned about 13.44% in an equity portfolio. But the S&P 500 did about 16.55%. And Dalbar lays that squarely at the feet of investor behavior, zigging when they should have zagged, or just zigging when they should have just left it alone, quite frankly. And so when we look at long-term investing, Scott, one of the things that is a hallmark of the GenWealth well thought out, crafted investment philosophy is sometimes a portfolio just needs a good leaving alone.
Yeah, no question about it. And, a more productive philosophy is to not try to influence the market, try to make moves when you shouldn't, do the wrong thing at the wrong time for the wrong reason, but allow the market influences to improve your performance. What do we mean by that? Understand that equities are a long-term investment. I think these last 14 months have taught us that, if nothing else, right? If we have short-term investments in the stock market, we could be forced to sell or walk into selling at the worst possible times.
Clearly, and I think we should have learned that back in 2007, 2008. But the problem is, number one, we've got short-term memories, and we get really happy when things are going well, and we think it's always going to be that way. We have something called recency bias that kicks in. And so you've got to be in a situation where you understand the fundamentals of long-term investing, and equities fall into that long-term category.
And what's been interesting in my reviews with clients is when I have clients who are successfully retired, they've reached financial independence, they lived through 2008, they're not the ones panicked. They're the ones that are just like, yeah, we're down. We know it's fine. Because of the strategy that we have in place, those are their funds they don't need for 15 more years. So they're not stressed about it because they've walked through this before.
And that doesn't mean you don't have a model in your investment strategy that does change investments. We're not saying buy something and just let it ride for 30 years, but it does mean don't bail on it when the news is bad, and don't jump in when the news is good.
Scott, I'm famous for saying that what destroys a portfolio is not a bear market, but it's destroyed in a bear market when you sell.
Right.
That is what destroys a portfolio. Clearly, if you hang on to it, history tells us that it will recover. And if you have a long-term perspective, I was just looking at a client's review paperwork that we've got coming up tomorrow. His 3-year average is actually pretty good.
Yep.
His 1-year average is down,
right,
but his 3-year average is actually pretty good. And we should be in this for the long term because retirement is a long-term proposition.
Yeah, you think about that from, you mentioned the term recency bias. I'm going to define that a little bit clearly because it does happen. I've had some clients come in and before we get to that review sheet, they'll go, well, I'm down about $90,000 or whatever it is. And I'm like, well, not really. Let's take a look. What are you basing that on? And of course, they're thinking
the last 12 months.
Their high mark.
They're thinking high water mark.
From the top of the mountain. Yeah, they've come back maybe $90,000 in that case. But when you stretch that timeline out and go, well, where were we 3 years ago? Where were we 5 years ago? It's a different perspective, and it has to be kept in the long term.
Yeah, they get anchored on that high water mark and think it's always supposed to go up, but it doesn't do that. But when you pull out and take a look at that bigger perspective, it's like I talk about the knothole versus the entire yard of your neighbor. Looking through the knothole in the fence versus looking over that fence, you can kind of get a different perspective.
All right, so misconception number 2 on today's Get Ready for the Future show, we're talking about 5 market misconceptions that we can really think about that will allow us to refocus and better prepare for our financial future, it's I need to be rich to invest.
I'm really grateful this one's wrong because I would certainly not put myself in that category. I didn't start investing until I started working here in my mid-30s.
Yeah.
But I think this one, many years ago, accessing investments was much more difficult. If you didn't have an employer plan, you may not even realize there were IRAs out there. So that was something that I have a heavy heart for. But there are so many opportunities now and so many different vehicles you can use. With mutual funds, for instance, you can start with a very small balance and just get that ball rolling.
Scott, who has perpetuated this myth more than anybody else? The politicians.
Yeah.
Mm-hmm.
Because the politicians come on TV and say, something like, well, the stock market only benefits the wealthiest among us. Well, that's just a load of crap. I'm sorry. That's exactly what it is, because I will guarantee you almost all of the listeners of this show and the vast majority of Arkansans have some of their retirement money in the stock market.
Mm-hmm.
And I would say that they're not necessarily in that category of the wealthiest among us. Mm-hmm. Do the wealthy benefit from the stock market? Absolutely so. But average Joe out there benefits from the stock market, and really mutual funds democratized the stock market, because you could literally go in for as little in some mutual funds as $25 a month and invest in the equities of great American companies and have a well-diversified portfolio. It's just a lie that you have to be rich to be investing.
Go ahead.
Well, now you think about who we see on a day-to-day basis. The lineman in energy has access to an employer plan, and he can use that to get going, including a match. So if you have a retirement plan at work, that's a beautiful vehicle for you to get started with. You don't have to make $700,000 a year to invest. I would say the average median income of most of our retirees was probably closer to $100,000.
Can I say one other thing about this? And I know about this much about this, but I have to rant about this for just a moment. I understand I'm not a TikTok person, but I understand that the big trend on TikTok now are these guys that are cruising down the road in their Maserati or whatever,
yes.
and they're talking about take all your money out of the market and go put it in this or whatever, and the market's all for the rich people and they're taking advantage of you. That is a lie from the pit of hell. It just is. It is them trying to make some sort of bank on their
fear.
Notoriety and on the fear that they can generate from people. Don't take your financial advice from TikTok.
Here is the truth. The stock market has been the vehicle that has created more wealth for more people than any instrument in human history.
That's right.
And if you're not in it over the long term, you're sitting on the sidelines and missing out a very good opportunity. My 22-year-old son, so let's bring this into real terms. My 22-year-old son has been putting $100 and now up to $200 a month into a Roth IRA since he was 18 years old.
He's got a good dad.
He's got thank you. I was going to say he's got a good start. He's got a good head start on financial independence. If he never changes that habit, he's going to be in great shape over 40 to 45 years until he's going to use that money. It doesn't take a lot. It just takes a little for a long time. Misconception number 3, higher risk always leads to higher return. Now, we love talking about the risk-reward scenario, right? I mean, there is some truth to you can't get a lot of return if you take no risk, but it doesn't mean higher risk always leads to higher return.
The key word in what you said, Scott, is always. Right. Anytime there is always or never in some advice that somebody is giving you, it is very high probability that it is wrong.
And I think about cryptocurrency when I think about this, because, it was kind of a fad for a minute there where people were just making insane returns, and then it failed. There was over 2,000 companies that failed in just a short period of time, and you could lose everything. So risk is not all equal. The risk you take on from like a mutual fund versus an individual stock, those are different risks. And the risk level has to be dependent upon your timeline and your ability to tolerate that risk.
And there's always that shiny object out there. Crypto is just the latest one, but there's always something out there that somebody feels like, oh, this is it. This is the ticket. I found it. Look, you're on a journey searching for something you'll never find, because there is no get-rich-quick scheme.
No.
There's a lot of schemes out there that will tell you can get rich quickly, but it doesn't work that way. What you want to do is you want to have a plan to get rich slowly and be able to accumulate wealth and have real financial independence, not just financial independence on paper like some of those crypto people had. Unless they cashed out at just the right time, that financial independence they thought they had slipped right through their fingers.
And that was highlighted in a study that we've got here in front of us too. In 1972, there was a study that talked about the low volatility anomaly. So the idea was economists concluded that over the long run, stock portfolios with lesser variance, so less up and down, still making progress but not quite as much up and down, actually experienced greater average returns than their riskier counterparts. So if you have those bigger dips versus just kind of a slow and steady wins the race approach, you may actually fall behind what you could have without those.
Yeah, we've got a graphic on this as well. Let's take a look at that real quickly. And basically what you see is that there is a sort of a happy point here. Around that 5-6 mark, 4-5-6 mark on the scale there is where you get the highest return and more moderate volatility. Now, clearly, as you go on lower volatility, your return goes down. But what is really interesting is the higher volatility portfolios actually have lesser return than some of the more moderate volatility portfolios when you look at this scale. And this is what really we do in the ready to retire process, Scott, is that we look to lower volatility over time, because volatility is your friend when you are accumulating money in the market. When you're buying shares, the volatility drives the price down. You can buy more shares at that particular point in time. It works just the opposite in retirement, because when the market goes down and you have higher volatility, then you have to sell more shares in order to generate the same amount of income that you're needing for retirement.
When you think about it, and you think about it in terms of finding that hot stock pick, that's kind of what we're talking about. Don't go after that. Don't go chasing after returns. Put it into a long-term strategy for financial independence. The difference here is if you want to buy some individual stocks, that's great. There's no problem with that. You can do that with sideline money, right? It's not too far removed from your casino money, let's be honest, because you don't have any control over it. And when you have money invested in one company, it's kind of like the elevator being held up with one cable, right? If that cable snaps, everybody on the elevator is going down fast. But in a diversified strategy, you've got several cables, probably 30, 40, maybe even 50 holding up an elevator. So if 1 or 2 or 5 of those snapped, you're still going to make it safely to your destination. That's the concept you have to think about is, yeah, I mean, there's nothing, that's fun picking stocks. Like, I mean, I've got a few individual stocks, right? But I'm not counting on that for retirement. I'm not counting on that for financial independence.
That's your fun money.
That's fun money. So the truth is, it's not about picking the right single investment that's going to get you the greatest return. It's about a diversified approach that, if volatility is managed properly, can actually give you a better return than if you had gone with an individual investment vehicle. All right, so we're up to number 4 on our list of 5 market misconceptions that we're trying to get the thinking right here for you. If you've struggled to think about, man, the fear of the market with everything that's going on right now, I just don't think I want to be a part of it. We're trying to get you back into the right mindset for a better financial future. Misconception number 4, this is more about retirement. I can't retire until I reach age 65. So we're kind of taking the other approach here, right? We've talked about long-term investing. Leave it alone for the long haul. But this is maybe too far off thinking in some cases, right? I can't even think about retiring until age 65. That is, I think, statistically the most popular age that people think they're going to retire. Why is that? It's because when they get on Medicare, right? You're eligible for Medicare, and that's very understandable that a key concern is, what am I going to do about health insurance?
Because it is freakishly expensive once you hit your 60s if you're trying to self-pay.
Well, you know, it used to be that there was just almost an iron wall here that if you had any health issues, you couldn't qualify for a policy to cover you to get to Medicare if you wanted to retire, let's say at 60. Now there is no proof of insurability necessary to get coverage. The price is just through the roof. And so you've got to figure out, okay, can I do something to bridge that gap and to pay for health insurance for 2, 3, 4, 5 years, whatever it is, until I hit Medicare? So there is some legitimacy to looking at retirement at age 65, but there's no rule to that effect that says that you've got to wait until 65 to retire. We have people come in all the time saying, I can't retire until I'm 65 because because I can't draw my Social Security. Well, that's wrong. You can draw it before the full retirement age, which now is age 67 for most of us. But the truth is, retirement is not about age. It is about the ability to live financially independent. And if you can live financially independent, then you've got the opportunity to pull that trigger at whatever age you want to retire.
Yeah, and here's a point too. Financial independence and retirement are not necessarily the same thing.
Correct.
Right? You could reach financial independence if you have a plan to do so, and you can know by having that plan that I have reached it, but it doesn't necessarily mean you have to retire. It may mean that you are able to walk away from the job you don't like.
And there are several clients that I have who either have a work retirement or they've reached financial independence and they just love what they do, so they're staying on. But I think the key here is to try to get to that point of financial independence where, okay, I work because I want to, not because I have to, as early as possible. Because I've also had clients who had no intention of quitting at 60 or 62, but a family, health emergency happened, or their job was, they were let go from their job, and then there was nothing else out there that was really appropriate for them. So it's important to prioritize the right goal, which is that income replacement.
I don't want to belabor the point, but you hit on something really quick. You said work-tirement. Let's define that. Work-tirement is part-time work in retirement, working because you want to as opposed to because you have to. It's something that we advocate strongly here at GenWealth because it has great benefits. One benefit is it helps your portfolio stay healthy for a much longer period of time. It overcomes a longevity issue for trying to live on what money you have for an indeterminate amount of time. The other thing that it does is to allow you to be engaged. One of the things that I find that people really struggle with in retirement, they don't miss the work, they miss the people. They miss the engagement. They miss the socialization that work gives them. It is a huge, huge deal that people run slap into in retirement because they get frustrated with a job or something like that and they just go, I just got to retire. I just got to quit. 6 months later, they're wondering what they're going to do with themselves.
And one final point on misconception number 4, if you think you can't retire until age 65, it may also not be about Medicare, but it may be about Social Security because, originally Social Security, the full retirement age was 65. And I think a lot of people still think that's when I'm supposed to get Social Security benefits.
Well, I think they believe that if you start Medicare, you have to start Social Security as well, which is not correct.
But you can actually take reduced benefits early if you want to retire at 62. That's the earliest you can take them. And you can also delay them all the way until 70. I think this misconception aligns to kind of another myth that you're going to rely on Social Security to cover your expenses in retirement. And that is part of the misconception here, too. No doubt Social Security is a very important foundational part to your retirement income, but you should not count on it covering all of your expenses in retirement.
Well, and I would just compel people to do the math. That's what we would do if you come in to see us, is we would do the math. You do the math. Think about it. Is the Social Security check you're going to get net after taxes and after your Medicare withdrawal on your Social Security check, is that going to cover food, clothing, transportation, shelter, taxes, insurance, and then all of the essentials of life like, you don't even think about this being an essential of life, but it really is a cell phone bill. Does it cover that? Because people don't have landlines anymore. So you've got to cover all of the essential expenses with guaranteed income because those essential expenses are going to show up regardless of what may be going on in the stock market. You've got to have the ability to cover those expenses with guaranteed income.
And if you're trying to do that math, one resource you may want to look into is talking to Tony on our team, because those supplement policies that you're going to need when you retire can be substantial in cost. So you want to take some time to get the math on that as well as you're creating that retirement budget. And Tony at our team would be a great resource for that.
One other thing I'll say, that on our website at getreadyforthefuture.com, there is a balance sheet that basically addresses this whole income versus expenses in retirement. Go to getreadyforthefuture.com and go to the resources page, and you'll find that for you to actually be able to do the math.
All right, we've only got a couple of minutes left here, so let's roll through misconception number 5. I should stay out of the stock market if I'm retired. That is a big one because a lot of people, I think, and maybe it's you think that, hey, when I hit retirement, that is the stop sign, right? No more risk, no more growth. It is all about preservation. And the reality is retirement is not a stop sign. It's a yield sign. Yes, the investment strategy needs to change, but you still have to have a component of your portfolio invested in equities. And here's why. Because over the long term, those equities are likely going to, at least historically speaking, outpace inflation. And
Yeah, we all know about inflation these days, right?
We know it more than ever. With even at 6%, it's running still pretty hot. Even though it's coming back down, it's down to 6%. That's still huge. We've seen the grocery bills go up. We've seen our utility bills go up. We've seen the price of a new or used car go up tremendously over the last couple of years. So you can't have a flat income in retirement. Social Security's gotten some nice raises along with that inflation rate, John, but it's not going to keep up over time.
Isn't it ironic that the one thing that would cure the inflation ills of the future, not the current ones, but in the future, the one thing that would cure that, actually the two things, equities and real estate, are the two things that people get scared out of in times like this when the economy's uncertain. And what that tells me, Scott, is that is emotional thinking. And people want to do what feels good. And I love Dave Ramsey's comment about this. Children do what feels good. Adults actually have a plan and actually respond logically to things as opposed to emotionally. And I think there's a lot of people out there right now that are responding emotionally to things that they really should not be responding emotionally to. You may be putting off a retirement decision. If that's the case, that's an emotional decision. Unless you know your numbers, unless you know whether you can retire or not, the current situation of the economy should not dictate whether you should pull the trigger on retirement. What should dictate whether you should pull the trigger on retirement is whether or not you can continue to live in financial independence.
Certainly a misconception. You should not stay out of the stock market just because you are retired. All right, so those are the 5 market misconceptions. The final bell has rung. Teresa, we'll start with you on final thoughts.
So as a recap of what we've talked about, we want to talk about those 5 misconceptions one more time. Your advisor and you sadly cannot greatly influence your returns. So you've got to have a strategy in place and a plan in place. You don't need to be rich to invest. Higher risk doesn't always mean higher return. You don't have to wait till 65 unless you want to. And you shouldn't stay out of the market if you want to be retired successfully. So don't let that stuff hold you back. Educate yourself, do the math, and make a wise decision.
Scott, I think the biggest financial myth of all is that you can create financial independence just by throwing money at your 401k plan, or that you can successfully retire without a written strategy. I think that people who do that really end up in a bad place. Those that do plan and strategize and adjust that plan that goes along with that retirement, I think they've got a much higher probability of retiring successfully than somebody that just steps in and wings it.
Yeah, don't focus on the account value. That's my final thought. Get a plan in place. And if now is the time that you would like to begin planning, that is a great time to do it, because you can get half off at GenWealth your financial plan for the remainder of the month of March. So we've instituted this March Madness half-off offer, and we are running out of days on the calendar for you to take advantage of that. If you want to do that, you can text the word MADNESS to 501-381-5228 or call us at 866-653-PLAN.
Let's also talk about a workshop you guys have got coming up in Conway with that talks about estate planning.
Yes, we've got Chris Rippey, who is an estate planning attorney who's going to cooperate with us in this. It's April 4th at Hendrix College. Space is limited, but it's a free event if you'd like to come. You just go to getreadyforthefuture.com/estate planning to register, or you can call our number here.
And that's all the time we have for this week's Get Ready for the Future show. The 5 market misconceptions. Hopefully you've rethought them today, and you will redirect your mindset for a better financial future. See you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.